Kia ora, it's Joe. Still working with Tania Limited, pretty active this year. So the next thing they want us to look at is a share split. Alright, so just as a recap, we incorporated the company, we issued you shares for the purchase of a business from K Martin. We then went to the public with a share offering, and that was oversubscribed, so we accounted for that. Then we went to existing shareholders with a cash offer for 1 for 5 offering, raising some more capital and increasing the number of shares that we had. So we've been increasing the shares. Now we're going to look at a share split. So again, increasing the shares, all right? But there's no real increase in capital. It's just an increase in the number of shares, and sometimes that just makes them more tradable because when you split them, they become less valuable, right? Okay, so on the 1st of February, the directors decide to split the preference shares into 2 for 1. Okay, the fair value of the preference shares was $1.25 at this date. All right, so for every share you've got, you're going to end up with 2. Okay, so because there's no increase in actual capital, there's no journal required when you split shares, right? But you do need to update the share register because the number of shares is going to, in this case, for the preference shares, they're going to double, right? So this is a good opportunity for us to just make sure that we understand what's happening with the share register, all right? So we know that when we incorporated the company and we issued the shares, that we issued on the 1st of April, when the company set up, we issued 600,000 ordinary shares to K Martin, and then we issued a 50,000 preference shares. So that's what we issued to K Martin. Okay, so that's how we started off. Okay. The second thing we did is we went to the public, and we issued some ordinary shares and some preference shares, and they subscribed to 1 million ordinary shares and 300,000 preference shares. All right. So this is when we made a public offering. All right, and this is what people subscribe to. Okay, so the preference shares, people have been paying the same for. Actually, we went to the public. The public paid more than K Martin paid. All right, okay, so we're carrying on. Okay, and then we did to the ordinary share people, we offered them a 1 for 5. Okay, not all of them subscribed. Okay, 80% did. All right, and that should marry up to this figure here, and it does. All right, so there we go. So we're increasing the number of shares that we've got. All right, so therefore the total number of ordinary shares has climbed to that, and there's the total number of in value really. Okay, with the preference shares, we have now got to the share split part. All right, okay, so they didn't actually the cash offering on the 30th, there was nothing for that. Okay, the 12th, actually that was the 15th of the 12th, 15th of the 12th, 1-5. There was no cash offer for preference shares, so nothing moved there. But now this date, this is the one we're looking at, the 1st of the 2nd, 16. What we're saying is, if we give them 2 shares for every 1 they've got, obviously we're issuing another 350 shares. All right. Okay. So really, what we're ending up with is, and there's no consideration for those shares. All right. So what we're ending up with is 700,000 preference shares at that value. Okay. Okay, so that's doing a share split. Really, it's making sure that the register's up to date and people have got their share allocation. There's no actual journal entry. Next, we'll be moving on to the next task we've got to do for Tania Limited. But once again, I'll do that in a separate video.